Would you believe me if I told you you could learn ICT concepts in just 30 minutes? In my opinion, ICT concepts are very easy to understand, but very difficult to implement. I've wasted hundreds of hours diving into every concept, only to realize it didn't add an edge to my trading. That's why in this video, I'm gonna strip out everything that's not necessary and only give you what works. Not only that, but I'll provide simple exercises that you can follow that will instantly improve your trading edge. By the way, if you wanna learn how I made over $1.2 million using a straightforward process, I've put together a detailed PDF that you can check out in the description. Now, without wasting any more time, let's get into the video. Okay, so you want to speed run ICT concepts. So the first thing that I'm going to talk about is the sum of all these parts. The whole is greater than the sum of all these parts. So my point with this video is to strip out everything that I learned about ICT that doesn't work and only focus on the things that really make a difference in your trading. And I guarantee if you only focus on these couple things, it's going to really improve your trading, and you're not going to worry so much about adding new things to your system. Just have a very simple system that you can come to the markets, rely on, and trust the probabilities that they're going to pan out in your favor through the long term. So I'm going to go over each one of these concepts individually, and you may have heard about them. What I'm going to do differently in this video is give you guys actionable homework assignments that I spent a very long time actually doing this myself. When I had a really hard time trying to understand ICT concepts, and it felt like I was just learning all these new things and I couldn't just piece it all together, because what I realized was I was just not good at a couple things. And in order for you to be able to speed run effectively, you have to be efficient. And efficiency comes from knowing each concept in and out. And when I'm thinking about putting together a whole strategy based on ICT concepts, you have to be able to understand multiple things all at once. But when it comes time to studying before the speed run, there's a couple things that you have to understand. It's just when you have a specific concept and you're really bad at that one concept, you have to dial in and just focus on that one thing before you move on to the next. Because if you try and learn everything all at once, it's going to be much more difficult for you to get through to the final level and face the ultimate boss, which is the markets. So I'm going to go over what I think are the most important concepts that I took from the 2016 core content, and everything else, in my opinion, was just fluff. I did spend a lot of time studying on my own, diving into all these different things like seasonalities and weekly profiles and interest rates. But if I break my trading down now, it is so simple and it's almost brain dead that it really removes all the emotion from operating inside the markets. So the first thing that I'm going to talk about, which I believe is, in my opinion, one of the most important aspects to proper trading, is going to be your risk management. Because if you can't survive in the markets, you are going to have a very bad time. If you cannot find a way to keep your account alive and stay alive in the markets, you will not even get to the point where you're actually learning. So that is the biggest thing. And I know that ICT mentions you should be trading in a demo environment. I know that 90% of you guys are not doing that. You want to get in the markets, you want to trade live. And I will say that trading in a live environment is probably going to teach you more about yourself than a demo environment. So this is for everybody that's skipping ahead to straight to a live account. There's nothing wrong with that. I did it. I never really traded demo. I just think I didn't really take it seriously, and I know a lot of you guys out there cannot take this seriously unless you have some skin in the game. When it comes to risk management, the biggest thing is to be able to keep your account alive. If you cannot stay alive, you are going to be... First of all, if you blow up your account and you're losing and you're on a terrible losing streak, you're not going to want to learn. Let's just put it that way. When it comes time to sit down and actually do the exercises and the homework, if you have a really bad trading day, how many of you guys are, you should be backtesting, or you should be journaling, but when you have a bad day, it just kind of just shuts everything out. So as soon as you have a bad day, you can't get anything done because your emotions are tied down with that trade outcome now. So when it comes to risk management, the biggest thing is to just get comfortable with losing. And it's going to happen to you guys a lot. It happens to me a lot. I just took a loss this morning. I was able to mitigate that loss. But if I'm not comfortable with that loss, it's going to make me make poor decisions. Maybe I'm going to flip my bias, and maybe I'm going to revenge trade. Maybe I'm going to do things that are breaking my rules. So losing doesn't mean you're a bad trader. It's only a single data point. And that's something that ICT drove across in month 2, and it didn't really click for me for a very long time. So really focus on this, and I'm going to bring up this table right here, and I found this somewhere online. But hypothetically, over 100 trades, let's just say based on our win rate, these are your R results. These should be your R multiple results. So, 5R if you have a 30% win rate and a 2.5 risk reward. So anything that's green is showing you a positive risk to reward where you're going to get a specific R value out of, and these are kind of your averages. So anywhere I would say when you're just trying to get better, you need to focus on these smaller risk rewards, because if you can't produce, let's say, even a 50% win rate at a 1-to-1, you really don't have any business trying to aim for a 1-to-2 or a 1-to-3 or a 1-to-4 or a 1-to-5. Think about this like baby steps. And when you're, let's say if your win rate is at a 35% at a 1-to-1, what makes you think you're going to be able to hit a 35% at a 1-to-2, right? 1-to-1 should be easier than a 1-to-2. So starting from square one, if you want to speed run ICT concepts properly, you have to understand that there are necessary steps that you need to take in order to become a better trader. And gauging where you are in your trading journey is so important. Being realistic with yourself. When I was terrible, I would just say, I'm a shit trader. I don't know what I'm doing, and I can't even get a decent win rate at a 1-to-1. You know, maybe I'm closing my trades too early. Maybe I just don't have a high enough win rate. So not only is my risk reward being affected because I can't hold my trade to a 1-to-1, my win rate was terrible as well. So there was two areas that I needed to improve upon before I even started thinking about going to a 1-to-2 or a 1-to-3 or a 1-to-4 or 1-to-5. And this comes with exercise. It comes with practice. So if you're really, really terrible at trading, let's just say, and you still haven't found any consistency, focus on a 1-to-1 risk reward, because all you need is a 55% hit rate, which in my opinion, a 1-to-1 is not that hard to hit. And then over the course of 100 trades, you should come away hypothetically with 10R. Now, this is going to require you doing some exercises and getting sample sizes and getting comfortable with trades. Now, this doesn't even account for discretionary trading. But when you're first trying to practice and just get comfortable with numbers, because trading is, when you boil everything down, trading is a numbers game. And this is why this is really my go-to first module that I need everybody, every one of you guys that's watching this video. If you want to learn how to properly trade, I need you to get comfortable with the numbers. And not only with numbers as far as risk reward and win rate, but as comfortable with P&L in general. And stop looking at the dollar sign, how much you're risking and how much you're going to make. Just think about it as 1R. All right, Umar Ashraf talks about it all the time. Just think about R multiples. If I'm going to risk X, I need to make Y. And based on my risk of, let's say, 1, whatever 1 is your R value, risk reward, you need to make 1. That's your baby step exercise. So the biggest exercise that I'm going to tell you guys to take is getting used to just taking stop losses. Now, when it comes to actually taking a stop loss, just visualizing it is one thing, but then actually practicing taking that stop loss is a whole nother thing. Get really good at that, because how many of you out there are the type to get into a trade, you think it's going to pan out in your favor, and then all of a sudden you're managing your stop loss and adjusting it because you're afraid of it getting hit? That is an emotional control thing, and you need to be able to build that resilience. And it's not comfortable. Even right now, the amount of experience that I have, I'm still not comfortable when the trade is getting close to my stop loss. And that's just something that is never really going to go away. You're just going to get better at it. And getting better at it is being okay with the market going to your stop loss, because at the end of the day, the market is always right. So exercise number 1 is just getting used to taking stop loss. Force yourself into bad positions. I don't know if ICT's mentioned this or my good friend Rodrigo has mentioned this as far as psychology, but force yourself into bad positions and just watch your stop loss get hit over and over and over and over again. Recommend you do this in a demo environment or backtesting environment. This is one way to really build that emotional control when it comes to trading in the live markets and getting used to the number game. So let's just look at some of these other numbers. Let's say if you're averaging a 1-to-2 risk reward, you only need a 35% win rate to come away with 5R over the course of 100 trades. Now, 100 trades is a lot, but would you not be happy with a positive outcome as a trader, right? Let's say if you're a break-even trader or you're a negative trader, you're losing money. Being okay with having a 35% win rate is something that just you need to get over. That's the hump that you need to get over. And when we're talking about a speed run, this is like the first road bump in your journey. The first road bump is just getting used to the numbers, getting used to the fact that you are going to have losses in this game. You are going to mess up. You might break your rules and stuff. So breaking your rules and everything, that might impact your win rate, but having a low win rate does not mean you can't make money in the market. You can have a poor win rate with a decent risk reward. You can make tons of mistakes. I make mistakes all the time and I still come out ahead. But that's because I'm so comfortable with taking losses. I'm so comfortable with just coming back to the markets the following day, and I can survive. So don't, put all your chips in on one trade that you think is going to go in your direction, and then you end up taking a loss, and then it impacts your confidence for the next trade. Think about trades as one single data point in your equity curve. And there's plenty of exercises that you guys can do, but the one exercise that I'm, obviously going to have you guys do is just force yourself into bad trades in a backtesting environment and watch your stop loss get hit over and over and over again. Or just go ahead and take trades that you think might pan out and then watch it go against you and get stopped out. There's many different ways you can do this. Just get comfortable with the numbers, get comfortable with the fact that you are not going to have a 100% win rate, and get comfortable with the fact that you have to focus on just aiming for the low-hanging fruit, 1-to-1s, maybe 1-to-2s to start. Okay, don't graduate to 1-to-5s, 1-to-10s if you don't know how to get a 1-to-1. All right, that's way far beyond your skill level at this current moment. Exercise 2 is to build the sample size. All right, so you want to record 100 trades with detailed notes and figure out how many R you've achieved in that span. Now, I constantly do this even to this day. It's just getting sample sizes of your trades. But for me, it's more on a micro level where I'm getting the sample size from that specific week. That way I can just review it by the end of the week. So just understand that just because you have a really poor trade, you might have broken every rule in the book. But if you have enough chips to continue playing, that's the most important part. You can learn from those mistakes, make sure you're not going to make them again, or minimize them the next time you do make them. So based on our risk management, our risk reward, again, we don't need to overemphasize one winner or one loser. It's just a trade. Book the trade and move on, and focus on the long game. So over 100 trades, if you want results like these, right, 35R, 50R, 65R, these are very reasonable. Anywhere from 40% to 60% is kind of where I operate. I'm usually not at 35%. When I'm at 35% win rate, that's usually when I'm on tilt, but you can still come out ahead if you have proper risk reward. All right, so focus on the bulk of where this is from 40% to 60%, and then just aim for a 2 or a 3R. This is kind of my sweet spot. Anywhere in here, 2 to 3R, 40 to 60% over the course of 100 trades. Obviously, I'm not taking 100 trades in a month. That's pretty excessive, but just say you're going to take, maybe 100 trades over the course of 6 months or over the course of a year. Would you not be happy with some of these results just based on a set and forget mechanical strategy? Would you not be happy with some of these results? On the high end, 60% at a 3-to-1 risk reward, you're coming away with 140R. That is a ton, right? And this is just hypothetical, but even if you have a much lower win rate, let's say your win rate is 40%, you're still going to come away with 60R. That's a massive, massive gain. You're getting 4 out of 10 trades right. So get comfortable with taking lots of losses, all right? That's my biggest advice for you guys. So these exercises are based on you getting comfortable with losses, all right? Risk management is mostly getting comfortable taking losses, because if you can take a loss and not change your plan, not change your process, come to the markets the next day and implement that plan and process, you're going to be so much farther ahead than anybody that's struggling in the market. All right, so that's pillar number 1, risk management. That was talked about during month 2 core content, and just focusing on trading being a numbers game. All right, dealing ranges and impulse swings. So get familiar with the Fibonacci retracement tool and learn how to anchor the high and low to the right impulse legs. And I get questions about this pretty frequently. How do I determine the dealing range, or how do I know what to, where to anchor my high and low? So my biggest thing is to be able to make sure that these highs and lows are extremely, extremely obvious, and that when we have an impulse leg, that it really runs away from a specific level. If you have this really tiny, small consolidation, I'm usually just avoiding those entirely and not looking at those as impulse legs. But I'm going to make things easier for you guys. So in our exercise, you want to use specific ranges and plot your Fibonacci on them. So the easiest way that I can get this point across to you guys, because this is a speed run, right? We're just quickly going through these things, and then it's on you guys to actually do the exercises. So using last month's range, just find the high and the low that was made last month and plot your Fibonacci on there. All right. If it was a bullish month, make sure that the Fibonacci tool is drawn from the low to the high. And if it was a bearish month, make sure it's drawn from the high to the low. And that way you can find out where premium is, where discount is. I mean, obviously, if you take these numbers and just flip them to the other side, you're going to get 61% on this side, et cetera, and then these numbers will just flip. So just understanding where your 50% line is and whereabouts the premium and discount range is. So easiest ways to do it is to find last month's range, right? Plot the high and the low, and then study price. Maybe you're going to use last week's high and low, which is what you can do. Or maybe you're going to just use yesterday's high and low. So an exercise that I'm going to give you to all you guys is to just study 50 to 100 examples of this. So if you go into a backtesting software and let's say you have a bullish bias, all you need to do is, let's say if there's a bullish candle and then you're expecting the following day to be bullish, just plot a Fibonacci on the low of that day and then the high of that day. If the market trades down into a discount, that's what you're studying. You're studying to see if the market's going to trade down to a discount and then rally away. And you're not going to get a trade every single single day, but this is a very easy way for you to start studying dealing ranges properly. So if you plot the Fibonacci on yesterday's low and yesterday's high, you don't want to take a trade until we get back into discount. That's your exercise. Do that over the course of 2 to 3 years worth of data, and then you're gonna have an indication of where does this actually fit into my strategy and where can I actually determine the best points of entry. All right, so that's dealing ranges and impulse legs. Liquidity, all right, think of liquidity as the resting orders in the marketplace. So above old highs and below old lows are our major pools of liquidity. So that is in the form of previous yearly highs and lows, previous monthly highs and lows, previous weekly highs and lows, and previous daily highs and lows. All right, you can even get even more granular and think about Asian session highs and lows. But the market will gravitate towards low resistance liquidity to engage with those orders. So if there's a large pool of lows and they are very, very obvious, like triple bottom, triple or quadruple bottom, double bottoms, just study those and see how price gravitates to those levels. But as far as liquidity goes, I'm going to kind of zoom in a little bit just so you guys have a clear exercise on what to focus on. All you're going to do is, if you're bearish for the following day, so when you're backtesting, if you're bearish, find out how many times the previous daily highs ran out, and then the market trades in your favor. So if I was bearish here, you can clearly see that the previous daily high was ran out, and then you can zoom in and find out all the price action that occurred prior to the run lower. And that's really all you're looking for. If you're bullish, you're looking for a previous daily low to be ran out and then expansion higher. All right, so the exercises, you're going to back test and forward test 25 to 50 examples where, when bullish, price sweeps a previous monthly low, previous weekly low, or previous daily, this should be daily low, and then reverses, vice versa if bearish. And when you're going through these exercises, I'm going to point out again, you're not focused on all the other concepts, okay? Just blindly buy the market after it takes out a previous daily low. Don't worry about any of the other concepts. Just buy it as soon as it takes out the previous daily low, and then mark your results. Because this is what's going to be able to get you to tunnel vision on these different concepts and not worry so much about everything else going on. Because when you do it that way, you're going to start overthinking things. You're going to start overanalyzing, which is a problem that I had for a long time. And it's going to it's going to induce ADHD. You're going to think about all these other things that are going on in the market, and you're not really going to be focused on the things that actually make a difference. Because if you really break it down, the markets are extremely simple. You're either going to go up, down, or sideways. That's really all we're working with. And when I have a bullish premise, how many times do I see a daily low be ran out and then it reverses in my favor? Today, for example, NQ was a perfect example. We took out Monday's low and then we ran back higher and closed higher on the day. And there was no confirmation that I needed. As soon as we took out Monday's low, I'm just looking for a long position and placing my stop loss, giving myself enough room for a stop loss. And if I even dove down into a lower time frame, there's no confirmation that I'm looking at. I'm just looking at the run on the previous day's low. That's it. Okay. So when you're thinking about building your expertise when it comes to liquidity, only focus on liquidity. Focus on previous monthly highs, lows, previous weekly highs and lows, and previous daily highs and lows, and just watch price, how it responds at those levels. You can do this for months on end, and this is what you should be doing. I'm giving you guys the guidelines to speedrun ICT concepts, but the hard part is putting in the actual work to actually learn properly for you to be able to trade with confidence. Now, that confidence only comes from repetition, and repetition comes from doing these exercises. And the way I'm laying this out is in a way where it's very similar to if you were playing a professional sport. And I'm always going to relate this to basketball. If you're terrible at taking jump shots or layups, right? You're only focused on jump shots or layups. If I'm terrible at layups, I'm going to spend 8 hours Monday through Friday for a whole month only doing layups. And this is one thing that I learned that Kobe Bryant actually did. I believe Derrick Rose actually talked about this in a podcast, was when he came into the league, he was pretty much raw talent. And he was lacking in a lot of skill sets. So what he did was each offseason, he would only focus on one specific aspect of his game. He wasn't focusing on multiple things. So when he first came into the league, I believe his first offseason, he focused on footwork. He only focused on footwork. Yes, he was doing some of the other things that he probably needed to do at practice, but that was his main focus, was footwork. All right. And the way that I'm laying this out is to get you to speed run and be able to confidently do these things and confidently perform this analysis in the markets. But you cannot do it if you are not focused and concentrated on the right things. Now, these exercises are laid out in a way where you're going to tunnel vision and only focus on these things and stop getting distracted by a million other things. You're getting distracted by Twitter, you're getting distracted by YouTube, you're getting distracted by all these new concepts popping up, and you don't even know the basics. So getting back to the basics, risk management, dealing ranges, liquidity. We've gone through those. Inefficiency. So always visualize inefficiencies using the paint roller effect. Markets will often return to these levels to fill them in and give them a second coat before seeing any continuation. This is very simple. It's a very simple practice for you guys to study, and they're the majority of my trades. So the majority of my trades are fair value gaps because they're very easy to spot and they give me very clear areas to put stop loss placements. So just two examples, a bullish example and a bearish example. What you're going to do is backtest and forward test 25 to 50 examples where when bullish, price fills in the fair value gap and then expands the following days, and vice versa if bearish. You are only focused on this. When you're trying to study fair value gaps, you are only focused on doing this. Power of three. Nearly every bearish candle starts bullish and nearly every bullish candle starts bearish. So when it comes time to do the exercises for this one, go ahead and come up with a daily bias. Go ahead, flip a coin. It doesn't matter. Just lean one way or the other. Try to blindly buy the market below the midnight open and see how many times you get it right. And don't try to record RR for this exercise. Just put a W or an L and see how many days you get it right where you go long below the midnight open. If it's already above the midnight open, don't do anything. And vice versa, if bearish, if you have a bearish bias for the following day, try to go short above the midnight open, blindly sell it short above the midnight open without any other confirmation, and figure out how many times you get it right where the day closes bearish. And that's really all you're trying to do for this exercise, is just get good at practicing power of three and understanding that the most efficient pricing that you're going to get on a bearish day is going to be above that midnight open, right? And vice versa if bullish. So quickly running back through, these are the 5 things that I focus on. You don't need anything else. You don't need breakers. You don't need mitigation blocks. You don't need vacuum blocks. You don't need reapers. Just focus on these 5 things, and I guarantee you, if you put all of this together, you will have a profitable system. And then it comes down to just getting used to the numbers game and not getting so hung up on each and every trade where you're putting so much emphasis on those wins and losses and you're not able to step back and just look at trading for what it is as a whole. This is just data that we're working with, and it's just simple analysis and simple execution. And the simpler you can make things, the faster you're going to be able to run through these concepts and be able to actually implement them and understand them on a much deeper level, because you only have a couple things that you're focused on. You want to be a specialist, and you don't want to try and be a master of all, jack of all trades, master of none. Try to one trick pony each one of these things until your game is A+. So I know if you're watching this video, you're probably coming to here and saying, oh man, well, I'm really bad at risk management, but I'm also really bad at dealing ranges. And I'm kind of bad at liquidity, and I'm kind of bad at inefficiency, but maybe I'm okay at power of three. What you're trying to do then is you're trying to take all these crappy parts that you're inefficient at and mash them all together and think you're going to have a profitable system. Take a step back and go back to the roots and focus on one area at a time until you're really good at them. And just like that analogy I gave you guys with Kobe Bryant, if you want to speed run through these concepts, be my guest, but I'm giving you guys a guideline and I'm giving you clear exercises. You don't have to follow these exercises. These were just the ones that I did. So for the longest time, I didn't even understand Fibonacci really, and seeing that pan out live in the markets. So I would plot my Fibonacci retracement tool, and then I would delete it and then draw a fair value gap and then completely forget about it. But what you want to do is just hone in and really, really get good at doing each one of these and being very, very efficient at each one of them. Because when you put them all together, then you're going to have a killer trading system, which is the bonus exercise that I'm going to give you guys. Once you've done all this, and you guys can come up with however many examples you want to come up with. I personally was doing 25 to 50 examples, probably daily, honestly. So when I was just learning liquidity, I would just go through tons and tons of data and just only focus on liquidity. But then doing it in a live market is totally different. You have to implement that in a live market. So when you see the previous daily low or previous daily high being taken out, even if it's just intraday, watching it trade back into the range is a good example. And keeping notes of that and understanding that after we take out a previous daily high or previous daily low, right, there's a high chance that the market might go the other direction. Get used to trying to predict the market ahead of time. So when it takes out that daily low and you have a bullish bias, try to anticipate that the market's going to go higher. Then maybe you can start layering in some of the other things that you've learned. But what I don't want you guys to do is get stuck in this hamster wheel of learning and learning and learning and learning and then not applying any of it. And I was stuck in that same hamster wheel as well, which is why I'm doing this video, because if you want to learn ICT concepts fast and you don't want to go through the long drawn out process that I went through, I'm giving you guys the exact strategy that I used. So I kind of just took a step back and said, you know, I'm really bad at certain areas. Let me just hone in for a long time. So even when it came to risk management, I would have very poor risk management when it came time to position size. And when my position sizing was just all over the place, one trade I would be risking 1R, the next trade I'd be risking 2R, the next trade I'd be risking half an R. It was just all over the place. I just made it a point to trade and get a sample size of just using one consistent position size and do this for a whole month. That's how you're really going to get better. Is just focus on clear-cut rules that you're going to follow and clear-cut exercises that you're going to follow to improve your trading. Now, all of you guys might have different strengths and weaknesses. Maybe you're really good at spotting inefficiencies, but you're not so good at spotting liquidity. All right, then maybe just put inefficiencies on the back burner. There's no real order that you guys need to study this in, but these are, in my opinion, the 5 things that will make you a profitable trader if you focus on them. And I think that's where most traders are failing. They just lack the focus. And in today's fast-paced society where everybody's addicted to their phones, there's new things popping up all the time. Everybody's so distracted. How can you concentrate for long periods of time? Can you even sit down and read a book for more than 2 hours without checking your phone? That is a huge issue that you need to address if you want to become a proficient trader, because this requires diligent study, and diligent study comes from you setting aside everything else that you're trying to learn all at once and just focusing on one thing at a time. Focus in, hone in on it, and become an expert in that one specific area before you move on to the next concept. Because if you can't master one of these simple things, you have no business trying to add more things into your trading toolbox. Which in my point in my career, I have a full toolbox that I can go back to and pull from because I've spent the time with each concept intimately. And that's the goal, is to spend intimate time with each one of these concepts and learn how they work and learn how the markets move around these concepts and watch how they respect them and disrespect them and get comfortable with that. Because dealing ranges fail, liquidity raids fail, inefficiencies fail, and power of 3 fails all the time. But if you do it long enough, you will find opportunities that are more high probability than the ones that you're chasing every single day. So that bonus exercise, right? You want to, once you're at the point where you understand all these concepts, then you're going to go back and back test or forward test and get a sample size using all the concepts together. So you're going to look for a dealing range, you're going to look for a liquidity raid, you're going to look for fair value gaps, and you're going to look for power of 3. Throw in market structure if you want, but only do it if you spent intimate time with market structure. So to summarize and wrap things up, this was just a clear-cut guide to Speedrun ICT Concepts. And I'm trying to lay this out in a way where you can learn these things very quickly because, in my opinion, all these things are very simple. It doesn't take a whole lot of time for you to actually understand them. But when it comes time to implement them, I think a lot of people are tripping up because they're trying to implement everything all at once. And break things down into easy, learnable segments and try not to focus on too many things all at once. All right, focus on what is most important to you in that current moment. For me, risk management was awful, and I kind of understood everything else. So I really need to hone in and focus on risk management because that was really holding me back for quite a long time. And then I started moving on and honing in on all these other aspects of ICT concepts. If you enjoyed the video but are looking to get more direct guidance and have someone like me review your homework, provide advice, and trade live with you until it clicks, just like my student Dizon who's taken full advantage of my teaching, then make sure you book a call using the link in the description. Also, make sure to comment, like, subscribe, and I'll see you guys in the next video.